All right, Tushar Pradhan joins us. Let's take the conversation forward. We are certainly looking at a lot of moving parts. Not that we don't look at moving parts, but we are at what could be called as an interesting point where you can argue about growth and inflation dynamics, and I guess you will still not get a concrete answer. Tushar, good morning. Thank you for joining us. Depending on whom you are asking, Tushar, and rightly so, the world is divided. The bulls would say growth is not going to die. The bears would say, what's wrong with you? Look at inflation and look at what Fed and central bankers would do. How should one look at the world now?
Well, as you said, there are two views. I must argue that there are several views, and none of them agree at this point of time. Simply because we are at a very different, I would say, stage in history where it's a little unprecedented. We've just come off a very significant pandemic, come off as in, at least in Mumbai, I can say that the pandemic continues to increase its presence in other parts of the world. The uncertainty around it continues to remain very high. At the same time, we've got pretty significant volatility in the markets driven by a tremendous surge of liquidity. So I think how the end game is likely to be is always going to be debatable, because if you go back to the history and to try to say that, look, what has happened in such times in the past, you will argue that the markets tend to be cyclical. So after a very large upsurge, it is likely to come down. That is what history will tell you. However, there have been also other times in history where this kind of surge has continued way beyond logic. And I think that is really where the problem comes. So I think the answer is to not try to predict what is likely to happen, but be prepared for a range of outcomes and position your portfolios to kind of weather the storm if and when and how it comes. So I think not a single straight answer. It's going to be a guessing game throughout this period.
Tushar, financials have a 25% weightage on your portfolio. Now, this is much below the Nifty benchmark of 30% plus. Why is that? Because if economy has to do well, financials are always considered to be a higher proxy.
No, I agree with that. In fact, what we have looked at financials is from a prism of saying what else can be a safety net. As I mentioned to you, the range of outcomes as we are talking about are fairly divided. That's really where the portfolio positioning comes from. We are not really betting on the traditional economic recovery because there are phases to the economic recovery with repercussions on the markets. So what we call as a recovery phase followed by what is known as an expansion phase. So what tends to happen in an expansion phase is that the economy starts to really chug along, earnings growth starts to build, but conversely, it may not be the best times for the market because the PE ratings actually come down. So the PE actually derates. So for example, on few earnings on the restoration phase, as we call it, the PE may have climbed to 24 times. With the earnings growth coming very strong, it is likely that the PE actually derates because the earnings go up. So in a sense, once we pass this period of uncertainty into pretty robust earnings growth, it is very important to kind of hedge your bets because of what has done well and what will continue to do well. The kind of leaders in the next phase of the economic recovery in the stock markets actually change. So it may not be logical to kind of follow the economic path and then bet on the economic recoveries, but try to look forward, saying that once you are in an expansion phase, there are other parts of the economy which starts to do well from a market perspective. And the leaders try to take a little bit of a breather.
It's such a great point that we always look at historical correlations and tend to assume that what has worked in the past will work in the future. But I wish life was that simple. Tushar, IT has worked like a charm for everybody. Exponential growth. IT companies are telling me that they've never seen it like this ever in their life. Now that's the good part. And markets have re-rated those stocks. But on the other side, you got inflation. When I say inflation, wage inflation. And you got serious talent crunch. So should we also start focusing on that aspect after the recent run-up, that growth is there, but growth will come at a price and it may not benefit shareholders?
Yeah, I think again the opinion is divided because each of the companies follow a different business model. They are operating in different parts of the market, so it's kind of difficult to kind of put them together and say IT will do this. If you look at where the demand is coming from, where the shortages are, I think those are the areas to concentrate. I don't particularly worry about the shortages because the labor market prices itself. So which means if I were to say that I'm a client and I face a shortage of labor, then automatically my rates get adjusted upward because that is how the business works. Of course, there will be some transitioning period if some of the contracts are a little longer term in nature. But eventually, the labor market actually just adjusts to the demand situation. Thankfully for India, if you look at the available set, and we always argue, are there enough jobs, etc. We are in a very wonderful phase where we continue to generate this level of skilled engineers, software people who actually join the ranks. There is no shortage in terms of the business model as we talk about. The labor shortages we are talking about are in the US, they are in the developed world, and there is clearly a lot of demand for special skills in that area. But when you come to look at Indian software services and we try to look at the automation and the machine learning and the general trend to automation that we're seeing, I think it's a wonderful time. And I think the markets have clearly given us a signal about where the opportunity is. I wouldn't worry right away. It's a little too early to worry about all the things that you mentioned on the IT front. I think we are still in a good phase there.
Tushar, where other than IT are you finding opportunities in the market right now?
Well, it's a fairly open-ended question. In fact, there are many areas where we see opportunity. For example, this evergreen China plus one strategy, where the world is waking up to looking to diversify supply chains. We've already seen pretty significant upside to some of your companies in India, whether they're in specialty chemicals or textiles or some of the allied areas where supply chains have become a fairly important issue. We're looking at opportunities across the sectors in terms of looking away from a little more traditional into what's likely to happen in the future. So we are already seeing a very significant amount of rebuild happening on infrastructure. The government is very keen to kind of kickstart the economy. All of those beneficiaries in that supply chain downward, whether it is people who are supplying automation or something of significant specialist value, I think those are the areas where we see significant pickup in ordering. We are also seeing fairly interesting, I would say, expansion of the financial markets. I would say democratization of the financial market. So in the past, it used to be lending led. It was banks which would kind of front end the economic recovery. But today, we are seeing a lot many more ways of financing, whether you call it the NBFCs, whether you call it buy now, pay later kind of fintechs, which are moving across to kind of lend money, which is going into the hands of people who demand it. I think there's a lot more which is happening in these areas. So I would think that while you may not want to pinpoint any one area, I think the vectors of growth for the economy going forward are clearly very different. And I think there are many areas which are coming up, which were not usually the traditional, okay, what do we do? Industrials, financials, economic upturn. I think there is a lot more there now than before.
Sure. Makes sense. The other niggling worry, Tushar, that we were talking about up until this quarter numbers were the commodity cost pressures. And we've seen that spell out in FMCG companies, in paint companies, various other industries which have, felt the heat, even autos, for instance, which have, felt the heat of the commodity price escalation. Do you think that adjustment is behind us, or given the way commodity prices are moving, this could perhaps dampen margins further going forward?
Good question. I think commodities do move in cycles, and people were worried about this time that the cycle could extend a little bit beyond. my feeling is that this time, not only it has started tempering, but with the increased uncertainty in the world about lockdowns and their impact, I think the demand situation is correcting itself. So if you look at countries such as New Zealand, for example, one case and they've shut the whole country down. Of course, it's a fairly small country and they can go back quickly as well. And they're a lot more integrated as a nation to kind of adjust the levels. But the fact remains that people are worried about the spread of the disease. People are worried about the new variant. And essentially, commodities have something to do with sustained economic demand. We are also seeing some sort of tempering in terms of after the initial surge, in terms of how the demand starts to work out. So I think it was going to be a difficult situation from a commodities perspective and inflation perspective if we thought the COVID disaster was over. I think that would have been a very different environment. But right now, we are saying that let's not discount the fact that there could be a lingering effect of COVID. There could be expansion in the number of infected, especially in the developed countries, which will lead to a little bit of a tempering of the demand itself. And I think that will auto-adjust to commodity prices very quickly. So I think for the moment, as we see, we don't see this to be a very, very high risk at this time that commodity prices will run away from there.
I was going through the mid-year outlook report of HSBC Asset Management, where it has been stated that this is a favorable time for mid-caps in India. Can you explain to us why you're saying that? Because we have been seeing the broader markets under pressure. There has been concerns also. Are they overheated and is the momentum shifting towards the indices?
Question, because the way we look at mid-caps is how do we categorize them in India? There are the 100 largest companies by market cap, which is classified as large caps. And the next 150 companies by market cap are the companies which are classified as mid cap. Now, we are essentially talking about the next 150, which essentially means that these companies have already proven themselves, whether by way of sustainability of their business models, whether the fact that management quality is very high, or whether the fact that they've actually gained this sort of market cap over a period of time. And now they sit in a place where the next 10 years could be where some of these companies, take a pick, 5, 10, 15, 20, 25 companies out of this 150 really nice set of companies are likely to graduate to the large caps. And obviously some of the large caps will lose ground. So the whole point is, if you want to look for sustained success stories, I think this is a good ground. There is already a lot of, I would say, qualification which has gone into saying what is your universe out of which you chose the winners. And I think then applying your mind analytically, trying to figure out who the winners are likely to be, I think it becomes a little easier than trying to look at the entire universe and say, well, where are my next winners going to come from? So I think from a sustainability perspective, from the fact of where we are as an economy, and where likely the winners are likely to come to, I think mid-caps provide a very significant challenge to kind of look through, because as you mentioned, the valuations also have become a little more demanding. But the fact is, it's a fairly big universe. There are significant opportunities, given the fact that the term that you're looking for to invest continues to remain attractive, no matter where the valuations are as a group. And of course, there will be relative attractiveness and valuations within this group as well. So we find this to be a very, very attractive space at the moment.
Okay, so you're finding mid-caps to be very attractive. With that, Tushar Pradhan, I'd like to thank you for joining us live on The Market.